So what is DTI? DTI stands for debt to income ratio. It's a way to determine how much debt you have to how much money you make. And this is gross. This is how much you make before taxes, any insurance come out, any 401k, money you make, top end, right? And so why do you need to determine this? When it comes to mortgage lenders, they need to know how much they can approve you by knowing how much you can afford in their terms of affording, which is about 43% or 50% if you're going FHA. So where do you find the debt to include into your debt to income ratio? So it's monthly. So it's your monthly debt, right? It's your minimum credit card payments and your like car payments that you pay a month. Any student loans you have, or any like personal loans, like personal unsecured loans, that's also included into your debt. It could also be, which people don't know a lot, if you owe money to the IRS and you're making payments with them, that's included into your debt to income ratio. It gets confusing because it doesn't pop up into your like Credit Karma if you check. It's separate from that, but it is included as a debt to your debt to income ratio. And child support, this is a big one. Once again, it does not pop up into your credit report, but it is counted as debt to your debt to income ratio, which a lot of people will go through the whole process of the application, go make an offer on the house, get into underwriting, and they never told their lender that they pay child support or that they owe money to the IRS and make an installment, because they didn't think so. They didn't think they have to mention it because it doesn't pop up in their credit report. But they'll go to underwriting, and the underwriter will find that, have to adjust how much they're approved for, and if you're maxed on your approval, you're not getting that house. So please be clear and any money that you pay out, even if you think it's not included into your debt to income ratio, they will confirm it for you. But definitely IRS installments and child support is included into your debt. Second, what is your monthly income? What do you make a month grossly with nothing coming out? So no taxes, no 401k, no health insurance. What do you make top end? Okay, now here's the fun part. How do you calculate your DTI? Okay, now here's the fun part. How do you calculate your DTI? So, you want to take all your monthly debt, right? Let's say you have a $200 car payment. You have a $200 loan, personal loan or school loan, doesn't matter. You have $100 worth of credit cards. We're at $500, right? And you make probably, let's say $3,500 a month, which is a low end, but it is actually a median price, a median wage here in Milwaukee. That's the median wage is like $3,500 a month. Now you want to divide your debt by your income. So you take that debt, which is $500, and that gets divided by your $3,500, which equals to 0.14. Times that by 100 equals to 14%. So now you want to see what you can afford when you have your DTI as 14%. So how mortgage lenders see how much you can afford, they want to be under 43% of DTI with your mortgage payment. Your mortgage payment would include your principal, your interest, your PMI, your home insurance, and taxes. All that included is your mortgage payment, and that has to be added with your debt and your mortgage payment to stay under 43%. So how I calculate it is, so you found out your DTI, which is 14%. I subtract that from the 43%, which will leave you with 29%. So you have 29% to play with your how much you can afford for a home to still be under that 43%. So you take that 29% and you times that, well, you divide it by 100, which will equal 0.29%. So you take your monthly payment, you take your monthly income, you times that by 0.29, because that's your 29%. And that should equal $1,015. So that is how much you could afford with your debt and everything together to be under that 43% DTI. If that doesn't make sense, you can ask me more questions down below and I can try to break it down easier. But this is my simplest way to just like get straight to the point, which is divide your debt by your income equals to a low percentage, right? So like 10%, 14%, whatever. Then you subtract that by your max DTI percentage, right? So it's like 43%. Or you can even do 50 if you're going to top end it with FHA. And will leave you with a percentage left over. And that's going to be your monthly payment percentage that you could afford to be under your DTI percentage. So I'll do 500 divided by 3,500 equals 0.14. Then we subtract that by 0.43. That gives us 0.29. Then you take your monthly income, which is 3,500, times that by 0.29, which equals to 1,015. And that's how much you could afford if you make $3,500 a month with a $500 debt. Hopefully that was helpful. Hopefully I didn't complicate stuff too much and make it more of a headache. But if you do have any questions, let me know below and I will try to explain it even better. Even if you have your income and how much you make, I can help you with that as well. So let me know, and I hope I helped you, and I will see you in the next one.